Now that you know how to set up your chart, let's explain how your chart actually works. Now, there's something called a currency pair. Now, when you're looking at your currency pair, your currency to your left is always 1. Right now, we are on the Euro USD chart. As you can see, it tells us on top here. We are on our Euro USD chart. What that means, for every 1 euro, how many US dollars am I going to pay? When it comes to currency pairs, we have got a base and a quote currency. So, for example, if we are using Euro USD, what that means is Euro is my base currency because it is the currency to your left, and USD is my quote currency. It is my currency to my right. So when we see Euro USD, what we are looking at is for every 1 euro, how many dollars am I going to pay or receive? So when you are looking at your chart, the price that you see on your chart as price is fluctuating is the US dollar. How many US dollars am I going to pay for every 1 euro? And that exchange rate is what fluctuates. So you are trading the fluctuation of this exchange rate. So are we going to pay more dollars for every euro, or are we going to pay less dollars for every euro? And that is where your money is at. So the currency to your left is always your base currency, and the currency to your right is always your quote currency. Now let's look at another example. USD, so that's the US dollar, and ZAR, the South African rand. Now when you're looking at USD ZAR, USD is to your left. So it is always 1. ZAR is to your right. So the rand is what you will see on your charts. How many rands am I going to pay for every $1? USD is now your base, and ZAR is now your quote. Now let's get back to the chart and explain this further. Now that you know what you are looking at, this price is showing you how many US dollars you are going to pay or receive for every 1 euro. Now it goes to the question, how do these candlesticks come to be? How do I read these candlesticks? Now, we have something called time frames. So each of these candlesticks takes a specific time to form. Now what that means is that if we are on the 1 minute time frame, each candlestick is going to take 1 minute to form. It has got 60 seconds for price to fluctuate and go as high as it wants, as low as it wants. And it is going to show us the highest point price has been to, the lowest point price has been to, where price started and where price ended within that 1 minute. So this is how candlesticks form. We have got bullish candlesticks and we have got bearish candlesticks. Let's start with our bullish candlesticks. Now, we know that the bulls push the market up. Right? We know that that is a fact. The bulls push the market up. So, in order for you to move up, where must you start? You need to start at the bottom. So, this line over here is your open. The minute 60 seconds starts and you are sitting on 0 seconds, you only have this line, your open line. Now from the open, your price is going to fluctuate within that 1 minute. It's going to go up and down, up and down. So when it goes down from the open, it will reach this point, the tip of this stick. Now, what this means is that price reached this point and then turned around to go in the opposite direction. All this point is telling you is that I went down to that price. This is called a shadow. It leaves a shadow behind whenever it goes down to a certain price, and we call this the lowest low. And then price turns around and it goes all the way to the top. And once it reaches this point, it then turns around and starts going down again. So it did not go any further than this point right here. So this is called your highest high. Now, when you're looking at your highest high, you are simply notifying that price went up to this point within that moment. This is the highest point or the highest price that price reached within that 1 minute. And this is the lowest price that price reached within that 1 minute. Now from here, price started moving down, and as it was moving down, your 60 seconds was up, so it closed. This line over here is your close. So the line at the bottom is your open, the line at the top is your close. Let's look at a bearish candlestick. Now we know the bears are red. And they push the market down. Now in order for you to move down, where do you need to start? You need to start at the top. So your open or 0 seconds is right here at the top, at this line over here. We are focusing on this line over here, 0 seconds. So what this means is that from 0 seconds, price went all the way up, because remember, our shadows just tell you the highest and lowest points price reached within that 1 minute. So this is again our highest high. And once price reaches your highest high, it turns around and goes in the opposite direction all the way to the bottom. Now once it reaches the bottom, it turns around and goes back. So this point at the bottom here is your lowest low. It is the lowest point price has been to within that 1 minute. And as price is moving up, 60 seconds is up, so your candlestick closes. Now that you've gotten an explanation as to more or less how candlesticks form, let's watch it happen practically on the market. Pay attention to this here. Notice how this on top here is your close. When price goes above that line, this candlestick is green. But when it goes below that line, it turns red. Why? Because from your open, if from your open price moves down, we are bearish within that 1 minute. From your open price moves up, we are bullish within that 1 minute. So while your candlestick is still open, it does not know whether it is bullish or bearish. Notice how it went down to that point and it just left that shadow, just a little stick to let you know that this is the lowest price that I had been to. And if it goes lower, when it comes back up, the stick will be longer. Now notice how price starts, and it is simply a line. And then if price moves up and comes back down, it leaves that little stick. Notice how as price goes lower and lower, the stick gets longer and longer. Watch price go up, and as it goes down, notice that there is the shadow left behind. Can you see the shadow? Look at that long shadow. And then the minute it goes down below my open, I have a bearish candlestick. 60 seconds was up, so a new candlestick started forming. And this is literally how price continues to move and creates all these candlesticks. 60 seconds, where has price moved to within that 60 seconds? So now something you need to practice doing is telling the story of the candlestick. So we have got certain tools that move the chart forward. So this is called auto scroll. So it scrolls to the end of the chart every time you move back. Notice this is where I am. If you give it a few seconds, I am back to the beginning. And then this is to shift chart up. So it's just to move it away from the price so that you can focus on this general area here, because people find these numbers distracting. So we are going to remove auto scroll. And I'm going to go to the 1 hour chart. And I'm going to give you an example of how you tell the story of what happened in the market. Okay, I'm going to start here. Now this is a bullish candlestick. Why? Because it is green. And bulls push the market up. So where do I start? In order for me to go down, to go up, I need to start at the bottom. So this is my open right here at the bottom. From this point, price moved all the way down to this tip of the shadow, and then it turned around and went all the way up to the tip of this shadow. And as it was moving up, 60 seconds was up, so a new candlestick, 60 minutes was up, so a new candlestick started forming. From this point, price moved all the way up. It came back down very slightly because there's a small shadow, and as it came down, 60 minutes was up, so a new candlestick must form. Now let's bring the bulls and the bears into this equation. Let's focus on where the bulls reject the bears and where the bears reject the bulls. So on top here, I have got a bearish candlestick. The bears pushed the market down. So in order for me to start and move down, I need to start at the top. So on top here, this is my open. From my open, price moved all the way to the top. And at this point, the bears rejected the bulls because the bulls are the ones that moved price all the way to the top. And then the bears rejected the bulls, and then they came all the way to the bottom. And at this point, the bulls then rejected the bears. And as the bulls were pushing price up, 60 minutes was up, so a new candlestick needed to start forming. So the bulls tried to push it up again, but they only managed to get so far. Now, once they got to this point, the bears rejected the bulls and they pushed them all the way down to the bottom. Now, once you get to the bottom here, the bulls rejected the bears because they did not go any further. This is where they stopped. So the bulls rejected the bears and they started pushing price up. And as they were pushing price up, 60 minutes was up, so a new candlestick started forming. From this point, the bulls had full control of the market because there is absolutely no shadow at the bottom. And we moved all the way to the top. And at the top here, The bears rejected the bulls and they pushed the market down. And as they were moving down, 60 minutes was up. So bam, a new candlestick started to form. Now, by doing this and telling this story, what you are doing is you are putting it into your subconscious. So when you look at these candlesticks, you automatically know where the opens and closes are. So you need to go back into time and just practice telling this story on your candlesticks. It is probably the most important part of this course because through telling the story of the candlesticks, you will be able to spot patterns. Now, something I also need you to understand is currency pairs. Now, when you are looking at Euro USD, you are looking at the relationship between the euro and the dollar. Understand the way that the candlesticks form on the Euro USD chart is not going to be the same way that candlesticks form on USD CAD. So this is the US dollar versus the Canadian dollar. Why? Because the relationship is different. So the candlesticks essentially form the exact same way. It's the same principle, same open and close. You've got your shadows. But notice how the shadows on this specific currency pair, notice how long they are. Now, because you have different relationships between different countries, you cannot treat any of these currency pairs the same. And how you learn your different currency pairs is you can hover over the currency pair and it will tell you which country or which currency is. So this is the US dollar versus the Japanese yen, the Great British Pound versus the dollar, the US dollar versus the Canadian dollar, the US dollar versus the Swiss franc, the Australian dollar versus the US dollar, the New Zealand dollar versus the US dollar. Now, just hovering over each of these currency pairs, you will be able to tell which currencies are involved. But bear in mind, the relationship between all of them is completely different. So you cannot treat any one of them the same as the others. You've got to go into Forex trading with the mindset of whatever I spot on each pattern, whatever I spot on each currency pair is going to be specific to that currency pair. We'll get into more detail as to what you can spot later on in the course. So that is all for this lesson. See you in the next one.